When looking at all the different high-yielding investments in 2022, including business development companies, closed-end funds, master limited partnerships, and so forth, one sector stood apart for its bad performance last year. Mortgage REITs, otherwise known as mREITs, were exceptionally bad performers in 2022. Two of the largest mREIT ETFs, including the iShares Mortgage REIT ETF and the VanEck Mortgage REIT Income ETF, were both down roughly 31% last year. Compared to equity REITs, BDCs, and other dividend investments, mREITs performed the worst when it came to these types of investments. On top of poor stock performance, a handful of these companies, including Invesco Mortgage Capital, Orchid Capital, and Chimera Investment Corporation, announced sizable dividend cuts last year. With so much bad news in this sector, I think it's worth asking a few questions. Why have mREITs been performing so poorly? Why have companies specifically in this sector been announcing more dividend cuts than other sectors? Are there any decent mREITs out there, and what does the future hold for these companies? In 2023, is there going to be even worse news for these types of investments? In order to answer these questions, we'll have to have a proper understanding of how these investment types work, including how they conduct their business and how they earn revenue for shareholders. I also analyzed, to my knowledge, every single mortgage REIT that experienced a dividend cut in 2022, and I'll present my findings and share what all these companies had in common. With that being said, let's go ahead and get started. If I asked you to name some real estate investment trusts, assuming you knew what they were, what REITs would come to your mind first? Would companies like Realty Income, American Tower, and Crown Castle come up first in your mind? Odds are, if you ask the typical dividend investor to name some REITs, these would probably be some of the most popular answers. All of these companies are what's known as equity REITs, which are businesses that own physical real estate and then lease them out to tenants. The tenants pay the REIT rent money, which they then pay out to investors. It's a simple business model that's not too difficult to understand. Mortgage REITs, on the other hand, are like a totally different breed that in some ways share some similarities to equity REITs, but they differ a lot in how they conduct their business. Mortgage REITs buy or issue high-yielding real estate debt and other real estate securities. They raise money through either offering debt or issuing equity, and they use the proceeds to acquire things like mortgage-backed securities, credit risk transfer securities, mortgage servicing rights, among other types of investments, which can be pretty complex to the average investor. I've seen mortgage REITs described as being more like private equity funds, or even being described as being some kind of bank-like hybrid business, and I think that's understandable, because if you look at equity REITs, they're typically more concerned with things like property management and scoping the market for good real estate deals. Mortgage REITs, on the other hand, are more concerned about things like managing securities, forecasting mortgage payments, calculating the cost of borrowing, and so forth. Both types of REITs have the same requirements, though, which include having to pay 90% of their earnings to shareholders in the form of dividends. It's important to know that not all mortgage REITs are created the same and that these companies can vary a lot depending on how they conduct their business. For example, some mREITs issue their own mortgages, where others might instead choose to invest in already existing mortgages. Some invest heavily in mortgage-backed securities, whereas some might instead focus on mortgage servicing rights. Some invest in residential mortgages, and some invest in commercial mortgages. On top of all these differences, you also have some mortgage REITs that own both mortgages and physical properties like equity REITs. These are what's known as hybrid REITs. The way that most mREITs earn the majority of their money is the difference between what it costs the company to borrow money and the cost of lending their money. This is what's referred to as the spread for the company. For mREITs specifically, the current economic conditions that we're going through right now have been extremely challenging for a number of them, including Armor Residential, AGNC Investment Corp, MFA Financial, and the biggest mortgage REIT in the sector, NLY Capital. Nearly all of these companies either reduced their dividend last year or they performed a stock split. So let's take a look at some of the issues currently facing these investments, which have resulted in a lot of them seeing more share price declines last year compared to the average stock in the S&P 500. The biggest issue facing this industry right now are rising interest rates. For most mREITs, it's a serious issue for their bottom lines. When interest rates are high, it costs mortgage REITs more money to borrow the funds needed to invest in more mortgages. This decreases the spread between borrowing and lending by a considerable amount. It also results in their investments being less profitable, and as a result, they may attempt another tactic in order to boost returns, which I'll get into in a second. But with returns falling, mREITs will also earn less money from fewer mortgages that they hold in their investment portfolios, thus meaning that they'll have less money to pass on to investors in the form of dividends. As a result, when returns fall and profits shrink, mortgage REITs may attempt to boost returns by implementing more leverage. Using leverage is extremely common with mortgage REITs because they help boost returns on their investments. Some mREITs typically use more leverage than others. For example, mREITs that invest in agency mortgage-backed securities typically use a lot more leverage than others. This is because returns from mortgages that are backed by US-sponsored enterprises typically don't offer high returns. Investments that are deemed to be ultra-safe never offer the highest returns to investors. There's no way that NLY Capital, which is the largest investor of agency MBSs in the mREIT sector, could offer an extremely high dividend yield like this if it wasn't for leverage. But this is also a problem in our current economic environment. Using leverage is by nature risky because it involves using borrowed money to try and boost returns. And with the markets being so volatile right now, you can experience some pretty dramatic gains or some pretty dramatic losses. To give one example, Orchid Capital, which is a mortgage REIT that holds agency MBSs, had a leverage ratio of 8.2 as of September of 2022. But if you look further back, it was even as high as 9.9. So this is an extreme amount of leverage and carries significantly higher risk than dividend investments that use less leverage. So with so many mortgage REITs struggling right now, I think it's worth asking if these investments should be completely avoided. If you've been watching my channel for a while, you'll know that mortgage REITs are an investment type that I'm typically not a fan of. That's because many of them have long track records of falling share prices and dividend cuts. But I've also been monitoring this sector for many years, and I know that there are some REITs that do perform much better than others. Like I brought up at the beginning of this video, mREITs can vary a lot depending on what they actually invest in. It depends a lot on two different things, which is what the company invests in and the track record of the management team. With that in mind, I decided to take a deep look into the following mREITs that had a dividend cut last year or lost more than 30% of their total share price value last year, and I went through all of their financials and tried to see if there was a pattern. And fortunately, I found something interesting. My observation was that all of these mREITs are heavily invested in residential mortgage-backed securities. Most of them focus on agency MBSs and some invest in non-agency MBSs. Many of these companies like to tout the fact that they invest in government-backed mortgages as a way to try to make their stock sound more safe than it actually is. The truth is, even if you're invested in something that's generally viewed as being safer, you can still royally screw up in high interest rate environments and not manage your leverage well. These types of mortgage REITs can also experience prepayment risk, which is the mortgage holder paying off their mortgage much earlier than expected, but in this environment, I don't see this being a significant issue. So if mREITs that invest in residential MBSs typically have the worst performance up to this point, when mREITs actually do post better returns. It's been my observation over the years that mREITs that focus on investing in commercial mortgages, not residential, typically fare better than mREITs that invest in residential mortgages. That's not to say these companies can't go through dividend cuts or see dramatic share price declines, but mREITs that focus on commercial real estate mortgages, from what I've personally seen, typically perform much better. It's also been my experience that hybrid REITs and mREITs that focus on other securitized real estate investments have also fared better. Let's go ahead and take a look at some of these companies. Keep in mind, I'm just going to show you the past performance of these companies, and this is not a buy recommendation. I am personally a shareholder in a couple of these companies, though. Blackstone Mortgage Trust, ticker BXMT, is a mortgage REIT that invests in commercial senior mortgage loans. They don't invest in residential housing mortgages like NLY or Orchid do. But look at their dividend history over the last 9 years. With one brief reduction during the pandemic which was later restored, this mREIT has never cut its dividend. Compare that to Orchid Island's dividend history over the last 10 years, which is a disaster. Ares Commercial Real Estate Corporation, ticker ACRE, is another mREIT that invests in commercial mortgages. They're owned by the same company that owns Ares Capital, which is my favorite business development company. Look at their dividend history since their IPO. Not a single cut up to this point. If you compare that to Armor Residential, it's a complete night and day difference. Rhythm Capital, ticker RITM, is a company that recently decided to change its strategy. Today they're heavily invested in mortgage servicing rights and not so much in mortgages. They made this change after the pandemic, and as you can see, they haven't cut their dividend at all this year. Finally, Starwood Property Trust, ticker STWD, is a hybrid REIT that owns both physical properties and mortgages. Looking at their dividend distribution history over the last 10 years, we can also see not a single cut up to this point. Obviously, I don't know if any of these companies will ever cut their dividend, but at least up to this point, they've been doing significantly better than the other mREITs in this sector that we just talked about. If interest rates continue to go up in 2023, then mortgage REITs are going to be an asset class that are going to continue to suffer. But as we just saw, not all mREITs have proven to be bad investments. Good mREITs do exist, although the majority of them have seen their share price decline and their dividends be cut since their IPO. An important step that all investors need to take is looking at the previous performance of an mREIT that you have in mind. If you see a steady decline in share price and dividend distributions, it's a sign that the management team hasn't been doing a good job. But in summary, what I've noticed is that mREITs that invest heavily in agency MBSs have typically performed the worst over time, whereas commercial mortgages and hybrid REITs usually do much better. Even though most of these stocks typically don't offer much in terms of share price growth, you can usually get a much more stable dividend of around 8 to 10% on average.